All right, guys, welcome everybody. Today is Friday, October 4th, 2024. This is Income Navigators. You've got options. And today I'd like to talk about uh, put butterflies that I put on I try to space them out, put them on every couple of weeks. There are many different ways we can set up these trades. What I would like to do is just talk about general idea, what I look for, or how I go about choosing the strikes that are part of this trade, and what my plan for the trade. And this is a very general plan. Um, I also want to point one very important thing out for everyone is that I would like to encourage everybody to use some sort of analytical tool. You can, if you're using Thinkorswim, they have great analytics for modeling trades, moving strikes around, and it'll show you what your risk graph will look like. And then as you move strikes around, it'll change your risk graph. So spend the time. It does take time. But the more you use it, the more comfortable you're going to get with understanding and visualizing where your risks are. And this will help you navigate the trade from start to finish as long as you see what your risk graph currently looks like, where the risks are, and then you can plan your potential adjustments based on what you're seeing in your risk graph. So, first thing I want to ask for those that are in this meeting, do you trade butterflies? If so, what kind of butterflies? If you are trading some shorter term butterflies, longer term butterflies, broken wing, balanced butterflies. If anybody wants to put any information out there, we can definitely get a better sense of what you guys have been doing, and maybe you can point out some of the areas where you're having trouble with, and we'll kind of just go from there. For the time being, I'm going to um, show you this is a trade that I put on 10 days ago, right? So it's almost 2 weeks old. I put on this trade in two tranches. I started with a 5 lot and then I added another 5 lot. The first thing I look at is, well, number one, I have to plan, right? Like how much capital am I going to put into this trade total, right? What's my max size? And since this trade is defined risk, I don't really have to worry too much about my future buying power requirement because I know that if I set up a trade that has a $5,000 buying power requirement in the Reg T account, right? If it requires $5,000, regardless of what volatility is going to do, regardless of what the price is going to do, my max potential absolute loss in the trade is what I have to put up for this trade. So in this example here, what you're looking at on the screen, this is a 10 lot. And you can see that the max risk, max Reg T risk in this trade is just shy of $50,000, right? So if I say I'm going to do this trade and the most I want to have at risk in this trade is, let's say, $50,000. Now I know with a 10 lot, this is my max size, and any adjustments that I'm going to make, right? I'm going to try to collect additional credits, try to increase my potential reward to the right of the structure, but that will probably come with an additional buying power requirement. So I also need to figure out how to keep my buying power requirement in this trade not exceed that $50,000 that I'm committing in this trade. Now, does that mean, right, if I put on the trade that requires $50,000 to put this trade on, does it mean that I'm willing to lose $50,000 in this trade? The answer is absolutely not, right? I'm not willing to lose $50,000 in this trade, even though it does take $50,000 to put a 10 lot of this put butterfly. This $50,000 is what is required for me to put this trade on. And based on this $50,000 requirement, I'm going to try to make an X percent as my profit target. And also based on this number, I'm going to use some sort of a mental stop in place just in case the trade goes against me. So, for example, in this trade, if I'm committing $50,000 of capital, I'm going to try to make maybe 10% on it. So I'm going to try to hold this trade as long as I can. I'm going to try to make whatever adjustments I have to make in order to increase my potential profit in this trade. And I'm going to try to make as much as 10% return on this $50,000 capital. Does it mean that I'm going to put this trade on and walk away and come back on the day of expiration hoping that I'm somewhere in the tent? The answer is no, right? That's not proper risk management. That's very irresponsible. So I do need to monitor this trade. The good thing about this trade is that I don't have to sit on my computer and watch this trade all day long, tick by tick, right? I usually start these trades with somewhere around, maybe 60, maybe 70 days, 75 days. And in general, the more time we have until expiration, the more forgiving this trade is, especially early on in the trade, right? A lot can happen. Market can go up, market can go down. And as you can see, I don't know if you're able to see it well, but you can see that my T+0 right now is fairly smooth, both up and down, right? So the market could go down, 2%, and I'm still not inside of the tent. And you can see that on a 10 lot, right, my net exposure, my net delta, my directional risk in this trade is, just over 4. That's 4 S&P 500 points, 4 SPX points. So if the market goes down, maybe 2%, yes, my deltas are going to increase on the downside. So I have to monitor. But even in that case, if we go down 2% and my delta goes to 10, I still don't have a whole lot of directional risk, right? Because this position will be equivalent to being long 10 shares of SPX. Clearly, SPX doesn't have shares, but it'll move about plus or minus $10 for every one SPX point, right? If SPX goes up a point, I'll make $10. If SPX goes down 1 point, I'll lose $10. So that's the idea, right? The directional risk is very minimum at the very least when we start the trade, and then as this trade develops and we get closer to expiration, since we have negative gamma, we are going to be a lot more sensitive to price changes, but that's in the later stages of this trade. So the idea here is on the $50,000 position, I took in about just shy of $1,200 of credit. Clearly, that's nowhere near the $5,000 that I'm going to try to make on this trade. So my goal is to figure out some future adjustments that I'm going to need to make in order to get to as close as I possibly can to that profit target. I keep it very simple, right? There are many different ways we can possibly adjust this trade. We can add iron condors to it. We can sell call credit spreads. We can do calendar spreads. And those are all great potential adjustments, especially if you are an advanced trader and you've been around for a long time and you understand how to manage complex trades that don't only have these butterflies, but also have other trades such as the calendars and the iron condors. But the simplest way, right, for me to adjust this trade, as long as we remain above structure, and when I say structure, I mean you can see this is my risk profile, or this is my risk graph at expiration. So that's my structure. That's where this is what this risk graph is going to look like at expiration. T+0 is what my P&L line looks like today. So the easiest thing to do, as long as we are above structure, in order for me to increase my tail profit, right, where we are right now, the easiest thing to do is to sell put credit spreads. Either closer at the money, farther at the money, it doesn't make a difference. My go-to adjustment here would be at some point in the future, maybe it's in 2 weeks from now, right? And we can, take a look at what this trade would look like 2 weeks from now. As you can see, not a lot is going to change, right? My T plus zero line is actually rising closer to my payoff graph at expiration. I'm going to try to zoom in to show you, right? So T plus zero is going to rise, assuming that, the market is still somewhere where we are today and implied volatility isn't going to explode. If it's going to just come in a little bit over time in the next 2 weeks, if this trade is showing a, you know, let's say T plus 14, this trade is showing a PNL at plus 1350, right? So let's just stop here and make a quick calculation. So 1350 on $50,000 of risk, it's about 2.7%. If I can do that in 2 weeks, am I going to wait another 42 days to, make an additional, 7%? Maybe. Maybe I won't. Maybe I'm going to get out of this trade at, 2.5, maybe 3% and put a new trade on. Why? Because as I said earlier, the more time we have until expiration, the less attention this trade will require, right? That means you can check on this trade maybe once a day, and that's it. But as we start to get closer to expiration, even though 42 days until expiration is still a lot of time, but the closer we get to expiration, look at this trade at T plus maybe 27, right? If we're still above structure, this trade is really in good shape, and there's nothing that you need to do as far as protecting this trade. But if we start to move towards the center or the tent of this butterfly, you can see my T plus zero is starting to slope downwards, which means that, if we're somewhere around 5,500, maybe a month from now, and as the time, now we only have 29 days, as the time starts to run out, right, this trade is going to become more and more sensitive. As I continue to click through and get closer to expiration, you can see that this T plus zero line is becoming a lot more, well, we're going to see a lot more P&L variation for every 1 point that S&P will move, right? So I don't want to hold this trade and, test my luck to see what if, we end up somewhere here, or what if we go back up. I want to get out of this trade as soon as possible, even if I'm not hitting 10%. The 10% is over the, life of this trade. But if I'm making 3% in 3 weeks, I'm getting out and I'm going to put a new trade on. Right. So you kind of have to, there's no exact right or wrong time to exit a trade. Right. So I think that everyone has to think for themselves and figure out, right, whatever your P&L is today, is it good enough considering the amount of time you spent in the trade? Is it worth getting out and putting another trade on? Or maybe if you want to stay in the trade and do nothing and wait to see, if more time goes by, maybe another week, maybe another 2 weeks, and if this trade is going to improve, that's not wrong, right? I don't think there's right and wrong here. It's whatever is right for you. You do whatever is right for you. The wrong thing to do is to sit there and watch the trade. Let's say we are somewhere around 5,800 in the next 14 days, right? We know that if the price runs higher, at expiration, we cannot make any more than what than the credit that we collected. And the credit in this trade, as you can see, is $1,175. So if 14 days from now, we're at 5,800 and we're showing a P&L of, plus 1,250, you're not going to make $5,000 if the price continues to run higher. So essentially what you're doing is you are taking on the risk, even though the risk is far away, but that risk is still here, right? Because the market can, and we've seen it before, the market can go down 10% in 2 weeks. So if we're somewhere around 5,800 2 weeks from now, we're pretty much maxed out on our potential in this trade. Continue to sit on it and wait for things to improve. There's not a whole lot of improvement here. So either we're getting out and putting on a new trade, or we need to figure out a way to potentially increase our return outside of this structure to the right, right? We call this tail profit. And the way to do it, I would consider selling put credit spreads. And I like to start with at least rolling the upper longs down. So if I sell the 5,500s that I'm long and I move them down maybe 20 points. Now you can see that this green line is my adjusted risk graph at expiration, right? So the blue line is what it was. The green line is what it will be if I make this adjustment. This adjustment is currently going for about $3.25, right? So I'm doing 10 contracts. I'm bringing in additional 3,200 and whatever dollars. But you can also see that on the downside, right, because I'm selling a put credit spread, that requires additional margin. So now my margin goes to 65,000, and that will exceed that $50,000 that I had allocated to this trade. So to fix my margin requirement issue, I would also have to roll my downside long puts. So I buy back, I sell the 5250s and I roll them up maybe 20 points, right? So fifth from 5250 up to 5270, right? So this would be a put debit spread. So essentially what I did was I shrunk the size of this tent, right? So I'm giving up the potential profit inside the tent in exchange for a little bit more premium on the upside, but I'm also keeping my total risk or my Reg T risk in check, right? My goal is to keep my Reg T risk under $50,000. So I'm giving up some of the profit inside the tent, and I'm okay with that because I'm not looking to hold this trade until expiration. I don't care about all of this, right, at expiration. I'm not going to hold it until expiration. I'm going to get out of this trade way before expiration. So the profits inside the tent is really, um, it means nothing to me. I'm just trying to make adjustments to increase my potential reward outside of the tent to the right and control my downside risk at the same time. So if I was to roll my upper longs down 20 points and roll my downside longs up 20 points, I will have collected $1.60, right, times 10 contracts. So I'm increasing my potential reward to the upside to the tune of about $1,500. Let's call it that. Right. So you can see how this will change. My Reg T margin goes to 47,275, and my upside potential profit goes to 20, let's call this $2,700. Right. And this is what my adjusted, and this is T plus 14, and we're talking about being at, around 5,800. So at 5,800, we're showing a P&L of about plus 1,500, but we know we have max potential profit of close to $2,700. So that means there's about another $1,200 to be made as long as we sit on this trade and do nothing else going forward. So there's still potential, and that's the only way I would make this adjustment and continue to hold. Otherwise, if I'm here and I already maxed out my max potential reward to the upside with 42 days to go, I either need to make the adjustment to increase my potential reward to the upside, or I need to get out of this trade and put on the new trade. Right. So that's my probably I don't want to say favorite, but it's my go-to. That's the first adjustment that I consider to increase um, my potential reward on the upside. If I didn't want to move, or let's say if 2 weeks from now, if the price goes higher, we're probably not going to get the prices we're seeing today, right? So um, this is not a perfect example, but I'm just sharing this as an idea so that you get a sense. Maybe instead of collecting, $1,400, maybe we're only able to collect $800. But the idea, so we're increasing our potential reward to the right of the structure while dragging our downside long puts closer to at the money, and at the same time, we're keeping our Reg T risk in check. If the $800, right, if I roll my upper longs down and they drag my downside long puts up, and I'm only getting maybe 60 cents, right, which will increase on a 10 lot, will increase my potential reward by only $600. And I feel like that's not enough. I don't have to roll my upper longs down. I can sell a put credit spread closer at the money, right? So maybe I'll go to 55.50, right? I'll sell 10, another 20 points. Oops. Right? I will collect a higher credit by going a little bit closer to at the money. But now I have two problems here. Well, number one, by selling a put credit spread closer at the money, right, I collect more credit, which is great, but not so great as I still need to fix my downside problem, right? Because now my Reg T risk went to 65,000 and I need to fix that. So I need to roll my downside long puts. Maybe I'll roll them up 30 points. So that kind of fixes it. Maybe 30 points is a little too much. Maybe we go down to and make it 20 points. Right. So that kind of fixes it. So I'm not going to exceed that $50,000 number on the downside, which is good. I am increasing my potential reward to the right of the structure, which is good. I do have this small little area where if we end up somewhere between 55.50 and let's call this 54.85 at expiration, I have a problem here. Right. But again, I don't think it's a big problem because we're not looking to hold this position until expiration. So even if we do come down somewhere around this area here, we're probably not going to show a profit at the time. But as long as we continue to hold a little bit longer, and as the time runs off the clock, eventually this position will improve unless we continue to drift lower. And now, as the time runs and we're somewhere in this area, this little dip here becomes a real problem. Right. So I need to figure out how to get out of this little sea of death and, fix this position. So that's another way I can possibly look to make an adjustment. I can also use some very basic chart reading. And if we're, you know, trading outside of a Bollinger Band, or we're way outside of, whatever ATRs or whatever you use to get a overbought or oversold signals or conditions, right? We can not only roll the upper longs down, right? We can consider maybe we'll move the longs down 10 points, right? That brings in a credit. Don't worry about the downside. We'll fix that in a second. So we roll the upper longs down. We collected a credit. Since the market is overbought, maybe we'll take a little bit more risk. Now we don't have any risk to the upside. But if the market is telling us that we are overbought, maybe we sell a small call credit spread. That's going to bring in additional credit without additional margin. But now we collected two credits, one from the put credit spread, one from the call credit spread. We collected 2 credits. We don't have to put up additional margin on the upside, but we did introduce upside risk, which means that if the market takes off to the upside, if our chart reading is not so great and our overbought condition becomes more overbought and the market continues to run higher against us, we have to figure out how to fix this problem, because if we don't and we hold this position until expiration, we can possibly take a loss if the price is going to exceed the strikes of the call credit spread, right? So we have a problem on the upside that we need to monitor. And we don't need to, when I say need to monitor, we don't need to look at it, tick by tick, but we need to be aware that, if the market continues to move higher and the time is running off the clock, we need to take care of this problem sooner rather than later, because the longer we wait, the more expensive the adjustment is going to be. And we only have so much credit that we're collecting to work with, right? Because any adjustment to improve our position is going to be a debit transaction. We only have so much capital or so much credit that we're collecting to spend on any adjustments. And the longer we wait, the more expensive these adjustments will become, which will take away from our potential reward in this area between 5,500 and 6,130. Right, so that's another way to adjust. And like I said, we rolled the upper longs down. We introduced the call credit spread, and we have a small problem because our Reg T risk is exceeding that 50,000 by about $6,000. So maybe we need to move our puts up on the downside, move them up 5 points. 5 points isn't enough because we're still just over 50,000. So maybe we'll move them 10 points. All right, but that's the idea. And the only way, so like if I had to explain this to you, like step by step, without showing this to you, it would be a lot harder for both you and I to understand what we're talking about. But by using this tool, and I'm not saying that everybody should run out and, subscribe to Optionet Explorer, even though it'll probably help you be a better trader and be a lot better at making these kind of incremental adjustments. But if you want to use whatever tools that you use, being able to see how making these adjustments, roll this, put here, roll that, put there, sell a call spread, this, that, and the other, how does that change our risk graph? What does that do to our Greeks? Right. And at the same time, I think one of the most important parts is to understand your total risk, right? So if I committed $50,000 to this trade, whatever adjustments I'm making, I don't want to take my risk way up more than what I, plan for. So this is my planned capital, 50K for this trade. I'm going to try to do whatever adjustments I can to possibly get as close to my profit target as possible. And even in this scenario here, right, if I made this adjustment and I sit on it, I'm still not making $5,000, right, that I said I'm going to try to make. On $50,000, I want to get to as close to $5,000 as a profit target as possible, which means that maybe another, X amount of time, whatever, maybe another 2 weeks goes by, right? This is my adjusted risk graph, and this is what it looks like. If again, I'm sitting somewhere around 5,800 and I'm already maxing out my potential reward in this trade, I need to either make more adjustments to increase my potential reward, because by not doing anything, this position isn't going to improve. If anything, it's all downside from here. Sure, there may be a time where we're going to see T+0 go above the risk graph at expiration line, but that's temporary, and that eventually is going to come back down, and we cannot make any more than total credits that we have collected. And in this software, I can see that the total credit for this trade is going to be somewhere around, let's just call it $3,000. So if I still have 24 days to go, I've maxed out my potential reward here. I can continue to make adjustments to increase my potential reward outside of the structure. But I also have to consider the fact that there are 24 days. And now as the time starts to run into the last, 3 weeks, 2 weeks until expiration, this trade is going to become more sensitive to price change. And now I have to figure out if I want to continue to make adjustments and potentially figure out a way to um, drive in an additional $2,000 of credit, or do I just close it out? And let's say, if I made $3,000 in this trade on a $50,000 Reg T buying power requirement, right? 3,000 over 50,000, that's 6% over. This would be 32 plus 10, so 42 days, right? So it's about, just over 4% a month return on risk. Risk being that $50,000 capital that I had to put up to put this trade on. So if that's good enough, the answer is easy. Get out and set up a new trade. Why? Because a new trade will have more than 24 days until expiration, which means that it's going to be a lot more forgiving, right? I don't have to deal with near-term price fluctuations as much as if I was to hold this trade down to the last, couple of weeks, right? At T plus 15, if we're somewhere inside of 5,500 and maybe 6,000, so if we're in this 500-point range somewhere with 15 days to go, it's not a terrible spot to be. But if we're starting to move towards the edge of the expected move over the next 41 days, you can see that my T plus zero is really sloping downwards on the upside and on the downside. And that's what I'm trying to avoid. Okay, so there's a lot of ifs, thens, and it's kind of hard to plan for this, um, with uh, 56, 66, 75 days in advance, because I don't know what the price is going to do. So I'm going to have to be a little bit more reactive to what the price is doing. But what I'm going to do, I have a pretty good idea, and you should too. Now, if the problem is, if let's say we put this trade on and then the price goes down 5% and we're in the center of this tent, right? It all depends, how fast we get there. Like if we get there tomorrow, well, not tomorrow, but let's say if we get there sometime next week, assuming that volatility is going to pick up as well, if we move down 6% in a week, volatility is going to increase. And that's not going to help, right? We're going to see T plus zero line push downwards, and we're going to have a loss in this trade. So that's potentially a problem for us. Can we make some sort of adjustments to fix this problem? We can, right? On the way down, you can see that even without increasing volatility, but you can see right now, I have very small positive delta in this trade. And if you follow this delta line, on the way down, you can see that my delta goes from 419 to 540 to 730 to 976 to 12 to 16 to 20, 25, 30, 35, right? So on the way down, my delta is going to start to increase exponentially, and that's because of the short gamma, right? So the gamma is going to drive delta, and delta is going to increase on the way down, which means my directional exposure on the way down is going to increase. And the more the market goes down, the more losses we're going to accumulate. So to avoid or to help ourselves here, right, if we wanted to slow things down a little bit, right? On the way down, let's say we breach this tent, right? So we dip below 5,500. We're not ready to stop out of this trade, right? Because we think that, based on maybe charts or whatever it is that you can use, just don't look for excuses not to get out of a bad trade. Like if there's bad news, if the market is, moving three standard deviations to the downside, up three standard deviations one day, down three standard deviations the next day. This is not the best condition for this trade. So this is your first cue to get out of this trade. But if the market is just sliding downwards and we think that, the market is just pulling back, maybe we're coming down to some sort of key moving average, or we're looking for potential support around some level where we found buyers before, just to slow things down a little bit, what we can do, instead of doing all these adjustments where we're collecting a credit to raise our um, tail profit to the right of the structure, we need to fix this on the downside, which means, I think one of my favorite adjustments would be buying a 50 point wide put debit spread somewhere around delta maybe 25. And again, is that the right one? I have no idea, but I think that by structuring, or by at least modeling this adjustment, right? So we buy one 50 wide, so 54.85, 54.35. What does that do to my delta? Right now it takes my delta from +4 to +1. So, it shaves off about three deltas. And if my delta's 10, maybe I need to do three of these. Right? I want to get to as close to delta neutral as possible. Right? So that you can see my T+0 is now, I've given, I gave up my initial credit, but I'll have to worry about that later. Right now, that's not my problem. My problem is if the prices continues to push towards or inside the tent, my deltas are increasing. I just need to slow things down. Right? So I'm using a put debit spread. Right? If I buy a put debit spread, this is a bearish trade, which has negative delta, it has negative theta. Right? So I'm taking away from my theta. You can see that theta goes from 66 to 56. So I'm losing some theta, but I'm also flipping my delta. Now it's showing from +4 to -4, but around 5,500, it's going to be pretty close to neutral. What that means is that this put debit spread just neutralized this position, which means that if the market goes up or down the following day, we don't have a lot of directional exposure. So we can wait, maybe a day, two, maybe three, or a week, or however long, for the market to do what it has to do to find some sort of a balance. And then if it finds support and continues higher, now, right, we have to figure out how to recover what we just spent. We can close this put debit spread, or we can sell a put credit spread to raise our potential reward or tail profit at expiration to the right of the graph. So it's not as simple as, 1 + 1 = 2. You have to think about, what's happening, what am I trying to accomplish, and how do I get there? So for me, on the way down, yes, stopping out of this trade is the easiest adjustment, right? But at the same time, if this happens early on in the trade and there's still a lot of time that we can do something about it, right? At the very least, I want to neutralize this position, right? I want to cut my delta to 0 or close to it, maybe, shave off 2/3 of my directional exposure, and figure out, what am I going to do? What's my next step? So it'll take a little bit more attention, right? Monitoring this trade. But the good news is that if we move down, 3 or 4, or in the week, if we move down 6%, yes, this trade is going to be at a loss, right? But the good news is losses are going to be somewhat under control because, well, we have this put debit spread that in theory, should be increasing as the price is declining. We have a put credit spread that's not helping us, right? It's increasing in value and we're short this put credit spread, but our risk is capped on the downside. So we're not going to get a margin call. The margin isn't going to balloon because we have already defined our risk. We cannot lose more than we already had put up for this trade. So the broker is not going to ask you for any additional funds. You don't have to worry about your buying power. You just have to figure out how to bend the T+0 line in a way that's going to slow things down and give you a chance to figure out if you really need to stop out of the trade, if things are getting worse, or if things are going to improve. And then you need to figure out how to compensate for whatever adjustment you just did. All right, so that's another if then kind of a adjustment. All depends on what the market is doing. And that's what trading is, right? I get it. Everybody wants, I put on this trade, I walk away, 30 days later, I collect a paycheck and it's great. And it could work that way, right? In a very strong uptrending market, you put this trade on, the price goes higher, your maximum reward. If you do nothing else, the most you can make is what you collect up front. Maybe it's not 3% or 5 or 7% a month, but you don't have to do anything with this trade. But if you want to be a little bit more hands-on and you understand how to move some of these strikes around, right, to improve and advance this position, these trades are pretty high probability trades because, look, someone asked me earlier today on the trade that I put on, and let's just hop over to the trade that I put on today. So this trade from today, also, right, I'm going to commit about $50,000 to it. Right now, I'm at about 30, which means that I can add more to it. Or if I do adjustments that will require additional buying power, I have room for it, right? I collected a very small credit up front, which means that if I do nothing else, the most I can make is that I think I did this for a 10-cent credit, right? On a 10 lot, I collected $100 up front. Awesome. If I do nothing else and 77 days goes by and the price is somewhere above the long leg of this put debit spread, which is the upper long, 55.75. If the price is above 55.75 at expiration, the most this trade could make is $100 for me. Is it a great rate of return on, having to put up $30,000 for it? I don't think so. So I know that there's still things that I need to do with this trade between now and 77 days from now to improve my position. And if I'm going to bring in additional credit by rolling my upper longs or selling put credit spreads, call credit spreads, everything that I mentioned earlier today, that's going to take up more buying power. And that's why I left room for my margin requirement to increase. So let's go back for a second. When I said this is a fairly high probability trade, now if we just think about our upper longs, which is where our put debit spread starts, these puts are at 33 delta. They were, early on today, they were 35 delta. Now the market's pushing a little bit higher, and I think volatility is coming in a little bit. So deltas will change not only over price, but also over time and volatility. So everything will affect delta. So delta 30, let's just call this delta 35, which means that there is an implied probability that the price or S&P 500 is going to be somewhere above 55.75 65% of the time. But that's not all, right? Because, if we have a 65% probability of making this $100 that we collected up front and assume we do nothing else, well, we also have a potential profit if we're somewhere inside the tent, somewhere between the upper longs of the put debit spread and the downside break even, which is at around 53.75. Now, if we look at 53.75 and we use delta as a proxy for probability of success, right? 53.75 is a 20 delta, which means that there's about and again, this is an implied based on current implied volatility. Things will change as implied volatility changes. But for right now, there's about an 80% probability that we're going to end, right? At expiration, we're going to be somewhere above 53.75. Right? So 80% probability that this trade makes money. How much money? It'll depends what we do. If we do nothing else, we're going to make very little money. If we do nothing else and hold it until expiration, there's a chance that, if we end up somewhere in the trap, we're going to make big money. And there's only about a 20% probability that we lose money in this trade at expiration, or we're somewhere below break even on the downside. Right? I hope that makes sense. Now, Jeff, I know you're asking, how do you choose initial strikes for this trade and why? I think that there's no right and wrong way to set up this trade. I've seen these trades set up many different ways. It's all about what you're trying to accomplish or what you think the market is going to do, right? So just because I set up this trade with my upper longs at delta 35, is that the magic secret number that's going to make this trade a winner and everything else is going to fail? The answer is no. I feel, right? What's my downside break even? Right? I feel that this 5,400 level is a pretty decent potential support. I could be wrong, and the market has proven me wrong many times before. So I don't want to move my structure too much or too close to at the money, right? Because as I move the structure closer to at the money, I will also move my downside break even closer. I don't want to move my structure too far out of the money, which will give me a lot more safety. The problem with moving my structure farther out of the money as the time goes, right? And the longs and the shorts on my put debit spread are going to decay over time. I won't be able to roll my upper longs down and collect enough credit to raise my potential reward enough to justify return on risk. Right? Let me just try to say this again. If I move this structure farther out of the money, as the time goes, maybe 2 or 3 or a month from now, these options that are longs and shorts in the put debit spread, forget about the put credit spread. I want these options to go to zero, but I don't want this put debit spread to decrease so much over the next 30 days that by rolling my upper longs, I won't be able to collect additional or sufficient credit to raise my tail profit line, right? Because remember, I still, 30 days from now, right? And it probably won't happen like this, right? So the software implies that 30 days from now, assuming that we're still where we are, the put credit spreads are going to lose more than the put debit spreads, and my T plus zero line is going to rise above my graph at expiration. It does happen sometimes. It's not going to happen here. We would have to be a little bit closer to at the money, closer to the structure, and volatility will have to fall. I don't think we're going to see that because we have an event, we have an election coming up. So I think volatility is going to stay kind of elevated, and I just don't think the T plus zero is going to look this way 30 or 28 days from now. But ideally, um, maybe a month from now, this is November 1st, my goal is to move, as long as we're still to the right of the structure, my goal is to move my upper longs down and collect a credit, which will increase my potential reward outside of the tent to the right. Right? But if I set up my trade initially where the structure is already far out of the money, 30 days from now, these longs that are currently 30 delta, 30 days from now, they won't have enough credit for me to roll them down and increase my tail profit enough to where I'm, maybe making 3 or 4 or 5%. Right. So, but we can certainly look at what that would look like. Right. So this is T plus zero. And instead of, let's start a new trade, 77 days. Instead of going and placing our upper longs at 35 delta, what if we put this on at 20 delta, which is already giving us a super high probability, right? So maybe we'll go 53.75. We buy one. Then we go down 100 points to 52.75. And I like to keep um, the put debit spread about 100 points wide. We don't have to do it 100. You could make a really narrow, skinny butterfly, but you will have to increase the number of contracts, and that can potentially um, add up as far as commissions go. So I like to keep my put debit spread at about 100 points wide. I sell two, which is the center of this tent, at 52.75. And now I don't know where I'm gonna put the lower long or the downside long. Let's see what it looks like if I go down 100 points to 51.75. This is going to be a balanced butterfly, right? We have 100 points on the put debit spread, and we have 100 points on the put credit spread. They're both equal. My risk, I have both upside risk and downside risk. Only profit is in the middle or inside the tent. And you can see that the most I can lose here is the debit I'm paying, $245. So this is a very low probability if we keep it balanced. Very low probability, super high reward if we end up somewhere inside the tent at expiration. That's not the kind of game I want to play. So I'm going to move the downside longs down another. What did we do? We did 100 points on the upside, maybe another 25 points. So 51.50. Okay. Very similar to what we just looked at. Maybe I'll move them another 10 points. And this is very similar to what I put on today, except the structure is farther out of the money. What I did today, my center is at 54.75. So it's somewhere here. Oops. Right, somewhere here. This one is farther out of the money, which gives us more safety. You can see that our downside break even for this trade is 51.78. So let's call this 51.75. And 51.75 is a delta, let's call it 15. There's an 85% probability that this trade is going to make money, or the price is going to be somewhere above this downside break even. So by doing this trade, it's not a terrible idea. The problem I have with this is that I collect only a small, maybe $10, $15 credit up front, which is what I did earlier today with structure closer at the money. So that's not the problem. The problem I think I'm going to have here is 30 days from now, these upper long puts are already at delta 20. If they're at delta 10, rolling them down 10 points isn't going to, or 20 points isn't going to bringing sufficient credit to raise my potential reward to the upside. Right. So remember, I always go back to saying, there's two sides for everything. There's the good, there's the bad. So the good here is that we're pushing our structure farther out of the money, which gives us more safety. That's good. The bad is that our future adjustments to bringing additional credit, they're going to be very tough to make. We're going to have to sell something closer at the money. So these upper longs are out of play, in my opinion. We're going to have to sell something much closer at the money, which will introduce this sea of death somewhere between our upper longs and whatever strikes we choose to sell. I'm going to show you what that looks like. Let's say, 20 days from now, right? The price is doing whatever it's doing, and we decide to raise our tail profit. We need to bring in additional credit. Well, rolling these 53.75s will not be enough, or we'll have to move them way down in order to generate decent credit. So we are forced to go, higher at the money. So maybe we'll sell something like 55, 30s. Minus 10. Say we do it 20 points wide. That doesn't look right. Um, oh, shouldn't do 10, should only do one, right? So let's say we're moving 5,500s down, minus one, and then we buy one 20 points lower. All right, so now we're forced to sell a put credit spread closer at the money. We're not moving our upper longs down. We're actually selling a put credit spread above our structure, which will give us this sea of death, or whatever you want to call this dip here. And that's a problem too. Right. So we have to be, so I think in proper English, we would say by pushing the structure farther out of the money, we will have to be a lot more aggressive with our adjustments in the future, and more aggressive adjustments in the future will introduce other risks than just rolling the upper longs down and then potentially fixing our margin requirement. So I think in general, the idea is to start this trade with the upper long somewhere around delta 35 is a decent bet. And here's the key. This is one thing I'm going to add before I'm going to let everybody go. Your outlook for the near term, at least, right? This is what our structure looks like. This is from the trade I put on today. All right. Our price outlook has to be, stable in the near term, at least for the next, maybe 4 weeks. If we're expecting, the market to fly all over the place, well, it's not going to be a big problem if we move all over the place to the upside, but to the downside, we don't have a lot more than maybe 5%, 5% to the downside. So in order for this trade to work, the price has to remain stable. And if the price isn't stable, the market is trying to tell us something. So we need to figure out how to either remove our directional risk so that we can hold on to this trade near term until that instability will go away and the market finds balance, or we need to get out of the trade because, again, when we're putting on this trade, our price outlook near term is stable. If the market is doing something completely different, the market is telling us that we were wrong and it's time to either make adjustments or get out altogether. All right. So we went on for about an hour. I'm going to let everybody go. I hope that you have something to think about, something that you're going to maybe practice. I would love to hear your feedback. Questions are always welcome and they're always great. Remember, there's no such thing as stupid questions. The dumbest questions are those questions that are never asked. So please don't hesitate, reach out. You can find me on Discord. Um, you can also, comment on or ask questions about specific trades on the posts on the in the trade alert section on Discord. I want to wish everybody a happy and awesome weekend, and we'll come back next week. If you have something else, other topics you guys want to talk about, please don't hesitate to reach out. Let me know. Otherwise, have a good weekend, and we'll talk to you next week.